During our stock analysis, we are going to explore the key pillars, examine the ownership, look back at past results. We will find out what the analyst predictions are, as well as give the business a valuation, and examine the potential return on our investment. And finally, we will summarize our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests these are the key metrics when first evaluating a business. The first pillar we are going to explore is earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. For Crocs, this is just 2%, and is a modest increase since last year. Now, let's look at the free cash flow, which is the money a business can generate from its operations. And here we can see Crocs has not been able to increase this, as their free cash flow is down -4%. Then we come to the next pillar, which is revenue. And this tells us how good the company is at generating income before deducting expenses. Crocs' revenue has only increased by 3% in the trailing 12 months. Then we come to book value, which is calculated by subtracting the total liabilities from the total assets, and this indicates equity growth for the company. So, as for the last 12 months, Crocs' book value is up an excellent 12%. Now we want to turn our attention to the management of the business by looking at the return on invested capital and return on equity. These two measures allow us to assess a company's efficiency at allocating the capital under its control. Return on invested capital and return on equity is a superb 22% and 50%. Now we move on to debt. And Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. So, using their current free cash flow, they could pay the debt off within 3 years. In this next section, we now focus on other key metrics which help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is currently 56%, and this is very good, as we would like to see the gross margin over 40%. Next, we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying interest or tax. Their operating profit margin is a very healthy 26%, which is above the ideal 14% we would like. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for companies which have a free cash flow yield of 5% or higher. So, at 9.52% this looks excellent. As we are potential shareholders, we will now want to look at the average book value growth for the last 10 years. This is 100%, with the lowest point being this year at 12% for the trailing 12 months. And lastly, Bill Miller believes earnings growth is the biggest indicator to a company's stock price. The average growth for the last 5 years is 63%, both the book value growth and earnings growth look incredible, and perhaps will help when projecting these numbers forward in our valuation. In the comments section, I've included a link to the investors page in the annual report, if you want to check him out. This is Bitesize Investments, giving you a step-by-step approach on your investment journey. There are currently 4 super investors who own this company, and between them they invested $60.8 million in Crocs in Q1 of 2024. If we look back at Paul Tudor Jones's previous sales and purchases, we can see he has both bought and sold shares in Crocs in the past few years, and has added more shares to his portfolio in Q1 of 2024. He now has $8.91 million invested in Crocs, and this makes up about 0.11% of his overall portfolio. However, 5 other super investors have sold shares, totaling $31.7 million in Q1 of 2024. Ray Dalio has previously bought Crocs shares, but in the last couple of quarters he sold 20,000 shares. He sold 6.2% of his shares, but still has $14.1 million remaining in the company, which is 0.7% of his overall portfolio. Now we are going to look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. We can see that from 2017, Crocs have been steadily growing year on year, up until 2021, when they had a massive spike which could be attributed to the pandemic, but when the whole market dipped so did their share price, but now have made an incredible recovery, and have continued to grow. On average, the analysts believe that the price target should be about $151, but some believe it can go as high as $187. Analyst reports suggest that Crocs is undervalued at the moment, and the overall consensus is Crocs is a buy. Collectively, the analysts believe the company will grow between 1 and 10% over the next few years. I will use the current earnings per share of 13.10 as my starting point when creating a valuation. Based on a combination of the past growth, future analyst predictions, and the average book value for the past 10 years, I am going to estimate the earnings per share growth to be 10%. Then, I am going to give CROX an estimated PE ratio of 20. After that, I will project these numbers forward by 10 years. We then need to include a 15% return from our investment. This then gives me an estimated future stock price of about $680 per share for its future share price. And then we work out the current value, that Phil Town calls the sticker price, which is about $168. Then we apply a margin of safety. At 25% it gives me a buy price of about $126, which could occur if they don't beat their estimated earnings. As we can't rely on just one valuation model, I'm going to dig a little deeper and gather some more information. If you found this video useful, please consider giving it a like, or click on the link above to check out my last stock analysis, or continue to watch as we are going to look at the possible return, and compare the bull and bear cases. The return we would receive, if we bought at our 25% margin of safety price of $126, and sold in 10 years' time at our estimated future stock price of $680, would be 440%. But, this is dependent on our assumptions for the company being correct. At the moment, CROX don't provide a dividend. Let's find out more about the company and its competition. According to Morningstar, CROX has a narrow economic moat, and this is because they have a strong, unique and recognizable brand and loyal customer base. CROX has shown they're able to deliver consistent revenue growth, driven by strong sales in both their core CROX brand and the acquired Hey Dude brand. They have also shown they have an effective management team, as they are excellent at running the company effectively, and have used free cash flow to reduce debt and deliver a share buyback program. Now let's look at the bear case. CROX face increasing competition from other footwear brands, like Nike, and Adidas, and Skechers. There is also risk of market saturation, especially in key markets where CROX already has strong presence, as this could limit future growth. And lastly, as a consumer discretionary company, CROX performance is sensitive to economic downturns. If you have enjoyed the video, it would be greatly appreciated if you would like and subscribe to help the channel grow. And finally now, we'll summarize what we have found out about the company. When reviewing the key pillars, CROX scored 9 out of 12. Under ownership, 4 super investors have bought in the last few quarters, and 5 have sold shares. Their average share price is in an upward trend, and analysts are indicating CROX as a buy and they are predicting they will grow between 1 and 10%. Using the EPS growth model, my personal buy price would be $126 or less. If you click on the link above, you can find out about my personal portfolio. According to Morningstar, CROX have a narrow moat, and my final overall rating is 4.5 out of 6 stars, and I have given this a category A rating within my own stock watch list. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comments section to help me develop the content I'm creating.